So, Chris, I read your book, The Crash Course, as we know, 15 years ago, and I did a lot of the things inside of there, and they've made me very, very rich.
You are most welcome, and thank you for taking action.
A lot of people know because I talk about it. I went and bought that resort that had its water rights, and that's one of your, that's at the bottom of your pyramid. I ended up buying silver, gold, timber, oil, all the things, that you have at the very bottom. And I think, just that visual pyramid that was in your book really, really helped me a lot. I use it a lot on the channel.
Well, great. Yeah, it's a really important concept because, we're marketed to that money is wealth. But when you study it a little, you find out it's not money. It's something called currency. In fact, it's a specific type of currency. It's fiat, debt-based money, which has characteristics, but it's not wealth, right? It's a marker for wealth, and you can use it to get wealth. But what you just described is actual wealth: land, water, oil. Like, that's real wealth.
So can you walk through this for our listeners?
I'd be glad to, because this is really important concepts. This is your primary wealth of the land. So let's imagine two, land, country A and country B, right? Country A is like just sand. It's just some desert country. It has no water. There's no oil under the sand. That is and forever will be a very poor nation because it doesn't have primary wealth. And we'll contrast that with country B, like the United States. Abundant fresh water, really thick prairie soils. We've got oil under the ground, coal, natural gas, trees, all of those things. If you have those, then you can do things, right? If you live in that country A, all sand, no trees, right? Hard to make lumber, and do other things with that. So it's really important to understand that land is the source of all wealth, right? And we knew that, Kenny, right? 200 years ago, if you pulled into town and said, who's the richest person? There would be no confusion. People would point to the family that owned the most land because that was it, right? So it was really easy to understand. We've lost that story a little bit, but it's coming back. I think people need to know it. So let's imagine we live in country B, right? We've got all this water, oil, coal, all that good stuff, rich ore bodies. Well, we can take that primary wealth if we organize ourselves efficiently, right? We're not communists, we're capitalists. And then you can create secondary wealth out of that, which is that next layer up. And so these are things that are finished out of those real assets down below. So our trees become lumber. Those become, beautiful coffee tables. The oil comes out. We do all sorts of things with that besides move things around. We make things with it. It's amazing. We have coal, same story. You can do a whole lot with coal besides burn it and make electricity. It's an amazing substance.
If you don't know, I run MC Companies. We have over 300 employees, own over 10,000 apartments, and have transacted over $3 billion in real estate transactions. Over the next 12 months, I plan on buying over $1 billion of real estate. I'm going to be doing a free webinar on June 25th, going over exactly what we're doing as a company. You can click here to sign up.
Let's be clear about this. You can't really have a production layer unless you have that real asset layer. Now, Japan, they sneak this a little because they import all the real assets they don't have, right? But that's because they're stupidly good at the production layer, right? And that's awesome. But otherwise, Japan is exposed because they got to import that stuff and create some issues for them. And so that's where we're at. But if you have no real assets, you can't have production. How are you going to produce lumber without a tree to, saw up, right? So that's true whether we're making silicon chips or cars. It doesn't matter what we're making. If you're going to produce, you have to have access to a steady flow of affordable real assets down below. So that is the source of wealth. And then money is this thing we put on top of it, or currency. And we'll call that tertiary wealth, right? Primary on the bottom, secondary next up, tertiary, third order. And tertiary only has value, Ken, because you and I can exchange it for some of the stuff that's flowing up from one of those bottom two chunks. Like if I had all the money in the world and I was on that sandy country and I couldn't spend it on anything, I couldn't buy a yacht, I couldn't buy a car, I couldn't buy a Yanmar diesel, runabout for my farm. If I couldn't buy anything with it, it's of no value. So we value money because, hey, we get to exchange it for all that other stuff that's flowing up from the real assets and productive layers. But it's not real wealth itself. It's a claim on wealth. Because let me be clear, I value money because I can send a kid to college with it, because I can buy a house with it, because I can buy another piece of productive asset or a real asset down below. I can do something with it where we can see real limits to the amount of real assets in production that are out there. And this creates exciting opportunities for people who can see it. But maybe we can talk about that later. But when we talk about what's down there in the real asset layer, like just a simple example, every analyst is out there looking at copper saying, wow, we're going to need twice as much as we could possibly get out of the ground. And nobody's opening mines because it's a 15-year, multi-billion-dollar process with, too many regulations and blah, 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 blah. But somehow people are confused thinking that, well, we'll just buy more copper somehow. It's not going to happen because the production layer isn't going to be there. And there's so many stories like that right now. It's super important for people to understand this hierarchy that we're talking about here.
The further you get away from the base or the real assets, the worse position you're in, and the thing that collapses first is the very top, right?
Absolutely. It raises a really important concept, which is a fairly deep legal concept that's been turned on its head of late, but this is the idea of control. So we think we have control because we own the orange juice stock. Hey, I have a controlling part of this company that's involved in oranges and orange juice. But you don't. You control that portion of that productive layer that itself, that if it doesn't have access to the real asset underneath, you own a controlling interest of nothing. So it's really important in this day and age that we understand control, because a lot of people have been disconnected from the actual, when I say control, I mean, is it in your hot little hands? Like the parable, or people said, Chris, how would you summarize this? It's a bird in the hand is worth two in the bush. If you have it in your hot little hands, it's if it's in your control, you now actually have the capability of doing things with it, being smart with it, saving it for later, whatever you want to do. Most people don't understand, Ken, that when you're in the money layer, you actually, through various deceits and tricks, I would call them, you don't have control anymore. I mean, sure, your listeners know this, but other people don't, that your money in your bank account isn't your money.
Can you touch on debt a little bit about it? Because you always have a very good perspective on this, but it does not feel like it's going to be sustainable.
Well, it's not sustainable, and it's not just this, random internet dude saying that anymore. Jerome Powell says that now, right?
Yeah.
I was in front of Cynthia Loomis last summer, and she's a senator, and she said, from Wyoming, and she said, hey, what about this debt? And he shouldn't have to opine on debt because he's a monetary guy, not a fiscal guy, but he did. And so he said, well, technically we could deal with it, but the issue is that the debt is growing faster than our income, and that by definition is unsustainable. So, and he's repeated that several times. And then I think you saw that him and a couple of big private equity guys, I think Ray Dalio, and they got together and they're talking. Now you're hearing this open conversation of what you and I talked about years ago, which is, there's a math problem on this debt, right? And it's simple to understand. It's not hard, right? If your debt is growing at twice the rate of your income, you have a math problem. So we have a national math problem, and it's been there for a while. And it's not just federal debt. It's that I think in our next quarterly reading, which should be out soon, we're going to find out that total credit market debt in the U.S. is over $100 trillion. There's $315 trillion across the developed world. So the United States has 30% of the leverage and about 5% of the population. It's a thing, right? We're leveraged to the hilt, and nobody knows how to stop that. It's like, that's our system. And so we need more borrowing, and everything's conspired to make more borrowing. And then the Fed had to come along and all of a sudden pull the rug and jack rates from basically 0 to 5.4. That was a heck of a rug pull. And you mentioned some of the impacts, right, on office, multifamily. But can we be clear about this? This is having huge impacts. And obviously with credit card debt where it is, so here we are. And I think a lot of people, myself included, were kind of thinking that by now the Fed would already be on its easing campaign. They didn't really want to have to hike, but they kind of had to because inflation hit 8%. So what are you going to do? It's very politically unpopular. So they hiked. Here we are. The first half of the year is right through the windshield. And I don't think I can see a path to them cutting because inflation's been sticky. It's been a lot hotter than they thought, both on the core, the PPI, the CPI, however we're measuring it. It's not gone down. they're trying to massage it and say, oh, inflation is moderated. It's like, no, the rate of inflation stuff is still more expensive this year than last year, and it's pretty hideous. That's hard for families to get by on. So everybody's sort of clinging on, kind of hoping the Fed's going to cut rates and easy times come again. But I don't think they can at this point. I'm worried that actually it's going to, soon as a few months, prediction, it'll be 50-50 whether they hike or cut.
In my 35 years of real estate, I promised myself there's one mistake I would never do again. You'll have to make sure you watch that here.